Let's bring in Dean Maki, who says inflation will be the factor that keeps the Fed on hold and for longer. First cut in December. He's the chief economist at Point72 Asset Management. Dean, it's great to get your perspective here. Why do you think basically that this is a case for things coming in more solidly than expected, maybe on the economic front, certainly on the inflation front?
I think on the inflation front, the point I would make is that we've been above the Fed's 2% target for 4 years now. And core PC inflation, as we saw today, is sitting at 2.7% before the tariffs really have much of an effect. We think that the tariffs themselves will drive core inflation well above 3%, up into the 3.5% range. And that's just not an environment where the Fed's going to want to be cutting. We do think that we're starting to see some signs of the economy weakening, but the Fed can't really respond to that while inflation is moving higher.
Yeah, so that's kind of the worst of all outcomes, potentially, is that you want them to be thinking about lower. Does it matter, Dean, that at this point we might be talking about the next Fed chair who might have a very different point of view on that?
I don't think it matters for this Fed's policy choices. I mean, it obviously will matter when we get the new chair in May 2026. But I think this Fed is, I take them at their word. They make their choices based on the economic data as they see it, and also, what they see in their forecast.
Dean, I'm going to assume that you started off deliberately the way you did, saying that the important part of it is that we've been above target for 4 years. And that if we hadn't been above target, it's possible that the Fed could be treating the tariffs as a one-time price hike, look through them, and in fact even cut rates to adjust the negative effect on aggregate demand and growth.
Well, that's certainly what we saw in 2018 and 2019. Back then, inflation was below target and had been for some time. So the Fed didn't want to take the chance of running into a negative growth shock from the tariffs and the trade war more generally. And so they did cut 3 times in 2019. Right now, they don't really have that freedom because inflation's above target, not below target. So it does make a significant difference.
So just to get a little bit in the weeds here, this is essentially Waller's argument, who goes back to this May 2025 paper by a Fed official, Ed Nelson. And it's about looking through. And it says there's been this increasing move by central banks to look through one-time taxes. He talked about New Zealand, Australia. So, Dean, I'm hearing you say you are not a huge fan of Waller's current application of the look-through scenario.
I think it's a risky thing to do, both because we've been above target for 4 years, and also there are significant signs that consumers are expecting high inflation going forward. So inflation expectations, it's very hard to look, say, at the University of Michigan survey and say inflation expectations are well anchored. And that's one of the things that the Fed thinks needs to be the case if they're going to be cutting rates with inflation above target.
Yeah, so I'm sympathetic, Dean, to this idea that, you can't overreact to the tariff and inflation issue. Probably the underlying economy is more important. What do you think is going on with the underlying economy?
I think at this point, the softness we're seeing in consumer spending, there's 2 causes. One is that, as Steve mentioned, there was some tariff pull forward on some of the goods like autos. On the services side, though, we are seeing some genuine weakness in travel-related spending. And I think that's really uncertainty, a lot of it around the tariffs and consumers not really knowing how much the tariffs are going to negatively affect them. Going forward, I think it's going to be more the actual inflation that hits consumers and causes them to slow down their spending. At this point, I think it's more uncertainty and fear that has caused a pretty soft first half so far in consumer spending.